Hey everyone, hopefully you're having a good day. My name's Andy. My channel is Finding Value. Today we're going to go through Twitter, see what people are sharing on social media. I'll interject my financial opinions, generally related to three different topics: wealth building, commodities, and/or financial topics. So we're going to dive right in, take a look, see what people are sharing. If you want to follow me, it's at @Finance. And if you want to join our community, findingvalue.com. I dive deeper into all of these topics, looking for investment opportunities and sharing that with everyone in the community. I'm also answering questions from the community. What's coming up next is going to be portfolio position size, risk reward setups, how that all kind of interconnects with each other. Um, Physical metals is a part of that in that discussion. We can also talk about ratio swapping and all that stuff and some of the strategies I deploy and why I put so much portfolio allocations into each of these sectors and the strategies I'm deploying and how I make purchasing power gains doing it. So that will all be on the website. We do have a coupon code Black Friday. It's all one word, Black Friday, to get a discount if you're interested. So this one says someone is lying hard here, and it says home builders continuing to go up and U.S. new home sales. I don't think anything is lying here. I think it is a function of market conditions. So we are in a housing market shortage of new homes. Like the housing stock or inventory is smaller than how many families have gathered. And affordability is coming into play here. So the affordability and the interest rates, the mortgage rates, has slowed down US new home sales. If you look at the data, the majority of homes that people are buying are compared to history are much higher new home sales. So the home sales that we are getting of new homes is a larger chunk of total home sales, if that makes sense. So home builders are going up, and I think there's also a function of forward looking of the stock market at home builders. So they're looking ahead and saying, well, if interest rates were to drop, we're probably going to sell even more new homes because the home builders have an advantage. They can buy down interest rates for potential buyers. So the home sales is a function of volume. Home builders is a function of selling in relationship to volume. So yes, mortgage rates and interest rates have a huge impact on sales, and it will have a big impact if we were to see interest rates fall. And I think home builders are front running potential interest rate drops. That's my guess. That's only a guess. Rick says new homes are 26% of all for sale housing supply today, twice the industry norm of 13%. But keep in mind, we have low inventory levels. Back in 21-22, this chart was one of the first signals housing was entering a normal phase. And existing owners sat tight on rock bottom rates, and home builders gladly buy. As 2025 approaches, I'd expect this chart to slowly normalize. Resale supply should continue inching its way higher. Ground it's ceded to home builders, especially if home builders dial back their starts. Should mortgage rates stay around 7% approaching spring? And I think a lot of this deals with interest rates and the affordability for a lot of people. I know quite a few people that are still looking to buy homes that are not in homes currently. Ian Castle says building conviction in a position is the same as building trust in a relationship. It just takes time to develop. It can't be forced. The best relationships are built over time. The best positions are built over time. And it's not it's not always about building conviction as well. Um, it, it, you could say that investing is very much like a relationship. Some relationships are really good during certain periods of time, and at other times they are very bad. So you can build conviction in a company, but you still need to buy it at the right time. You still want to buy it when it's cheap and undervalued. It's kind of like dating someone else where your paths come across and you're perfect for each other at some point in your life. And then as time goes on, you grow apart from each other. It's the same thing with building relationships with stocks. Stocks are good for certain periods of market conditions, and then they're bad during other periods of market conditions. And you need to obviously build conviction in the companies that you own, but you also have to understand that they're not going to be the best thing for you for the entire life. There are going to be times that it's good, and there's going to be times that you don't want to be in it. That's what I'll say there. Bob Coleman says, I'm a big supporter of physical gold and silver. The issue is that money or capital is being drawn into digital assets and away from physical assets. As insane as this sounds, Wall Street is creating the avenues to keep this speculative fever going. And some people will say, oh, it's not, physical metals or physical assets, it's not coming back. I completely disagree. I think that we are in a bubble, and crypto is an extension. It is a creation of where we're at in the bubble. And no one's going to really figure this out until they look back on it. So physical gold and silver are the anti-bubble assets. It's the thing that is out of favor right now. So right now, everything that's in favor is AI, technology, and crypto. And you can see it with these people talking. You can look at Michael Saylor, you can look at Raoul Pal, you can look at those guys that have a lot of crypto, and they when you're I'm just an outsider observing, they sound crazy. Like when I listen to them, I'm like, oh God, these guys are like they're obsessed. Like that is what bubble talk sounds like to me. Now, could it continue higher for a while? It could, very well could. I'm not a genie in the bottle. If you rub me a right way, you get three wishes or something like that. Um, I just I look at it and I'm like, these guys sound crazy. It is a bunch of digits, and people are going crazy over it. And maybe there's more staying power to it. Maybe people get so poor that all they can do is game all day. Perhaps that's the case. I don't know. Maybe we'll go into such a physical shortage of materials out in the future that's all people are going to be able to afford is to stay home and game all day and look at Bitcoin and dream of getting rich off of this digital asset they call it. But nobody wants Bitcoin because of the service that Bitcoin provides. They all buy Bitcoin because they think it's going to get them rich. And if you were to look at any bubble in history, look at tulips. Do you think people were buying tulips because they wanted the tulip? Or do you think they were buying tulips because they thought they were going to get rich? So whenever you buy something, I buy assets that kick off cash flow. So I'm buying an investment because I believe in the service or the good that it provides, and I also think they're going to make a lot of money. So it is a function of providing some sort of utility to everyone in the system and then benefiting from that utility. Bitcoin, I'm struggling with, and I will continue to struggle with it because it has inherent design flaws when you look at it. Yeah, go look at the white papers. You guys obviously haven't read them. And then you've got everyone buying it not because of the utility it provides, but they're buying it because they think they're going to get rich. And then every time it goes up, more people pile in just because of the asset moving. That to me sounds like a bubble. Ian Castle again says, oftentimes the best investment opportunities are already in your portfolio. You've already done the work and you trust them. Don't be afraid to average up and own more of the management teams that are executing. I call that buying into strength. So the things that are working, you want to keep buying into it. You want to perhaps keep a good allocation to it. So what happens is some people say, well, what's the max position size in a portfolio? And I tell them, that's up to the person, and it depends how much money, how big the portfolio is, and it depends how much money's coming into the portfolio. So someone who just created a portfolio, if you have a 25% position size, that's not really a big deal if you're going to add a whole bunch of money into it. So if you keep adding money into it at a very fast pace, that 25% is going to shrink over time. If you're in a portfolio where you're in retirement, you're not adding any money to it, then you may not want to get over a portfolio position size of like 5 or 8%. There's no money's coming into it. So it really highly depends on how you want to average into these things and create these certain position sizes. It's also dependent on the income that's being generated and how much money is going back into the portfolio and reinvesting. Minor deck, silver production quarter three. Silver production for quarter three, the biggest producer is Fresnillo. And then we've got KGHM, we've got Vedanta, Pan American Silver, Southern Copper, Mag Silver, Glencore, and a whole bunch of other companies. But those are the big boys producing the majority of silver. We've got Eric Nuttall. Brazil is one of the last sources of meaningful non-OPEC oil supply growth. Yet by their own forecasts, oil will grow only modestly going forward. With few other remaining areas of growth, Guyana and Canada, the twilight of U.S. shale and disappointing exploration in Namibia, Vaca Muerta, however you pronounce it. This supports the view of peak non-OPEC production 2028. What does this mean? 2025 to be a year of digestion of non-OPEC supply growth versus 1.3 million barrels per day of demand growth. With the normalization of OPEC spare capacity thereafter, and with it the commencement of the bull cycle in oil, for now a $70-$80 WTI trading range seems reasonable. So let's take a look at this. This is Petrobras from November of 2024. It says total production, operated production from 2025 to 2029, 4.1, 4.3, 4.5, 4.6, 4.5 million barrels of oil equivalent per day. That's what we're seeing with this here. If you look over on the right-hand side, it says, we will use our technology and expertise to minimize production decline and perpetuate our value generation. And this is their operating assets and projects potentially peaking around 2025 onward and then declining. Some people will say, well, that's not good. Guys, the entire world looks far worse than this. Oil is everything. It is in everything. Most people have no clue how oil is, I would say, the foundation of advanced societies. And people who are like anti-oil, they have absolutely no clue what they were talking about. Oil is in everything. And you could just say anything, guys. You could say t-shirt, shorts, the chair you sit on, plastics, the monitor you're looking at, the camera I'm talking into, my computer, my cell phone, all of my pens, the ink, everything. It's all oil. So if this declines, I'm not talking about Brazil specifically, but if it declines in the entire world, we are going to be hurting. It's going to be highly inflationary. And I think that's going to come. And I think we're going to see problems with increasing shale production out in the future 3, 4, 5 years. The problem is you got to front run this. You got to front load that move. And I think maybe the only way that you could basically handle this is if you put everybody into a recession. And that's kind of what I think they're trying to do. I think they're trying to put everyone into recession. They're trying to go away from oil, but they can't. Germany and all these other countries, they just can't get away from it. And then here's the problem. If oil starts having a problem, you're going to start seeing problems in currencies and bond markets. And if you start getting problems in currency and bond markets, that's your big, gigantic move in hard assets. People aren't going to want digital money necessarily because digital money is just an extension of the oil. It needs all that energy. But if energy is the thing that's short, you're going to want physical things that have embedded energy in it. And these are concepts way beyond what most people talk about, I think. They don't really think about it like that. If ever and the most undervalued asset, a lot of people say silver is. I hate to say it, it's oil. Go dig a hole in your backyard, see how long it takes. Go get a mechanized backhoe or something and dig with that. What does that run on? It runs on diesel most likely. It's going to run on oil. And even if we go electricity and we try doing all these batteries and stuff, it's still the most undervalued thing because it can create work from oil or diesel or wherever, natural gas, in the thousands or hundreds of thousands of man hours. And paying people to do that is going to be just ridiculous cost. Breakaway freight futures AM update. So dry bulk's down pretty big. Capesize and Panamax 6% and 3% respectively, and tankers are up. VLCC up 2%, Suezmax up 4%. Mining demand to soar. So BHP predicts a 70% surge, 22.1 million tons by 2050. Can supply keep up? And this is just ridiculous. 16 times the Escondida mine, which I think is the largest mine in the world. It's the largest copper mine in the world today with 1.35 million tons production capacity, and we need 16 of them. I'm going to tell you this. We're not going to be able to do that. That's my guess. And it's going to deal with how much oil we can produce. Because really what copper is just a derivative of oil. We're just converting oil and that energy from oil and diesel and all those things and the lubricants and all that crap to copper, which is dug out of the ground. So everything we have in this world is a byproduct of the efficiency that we have gained in mining it out of the ground. The problem is we are using 3 or 4 barrels of oil for every single barrel we are finding. We are running deficits in oil massively compared to our reserves over long periods of time. Yes, we can continue to go, but if we are moving upward, producing more and more oil at some percent increase, when you hit the 50th percent mark, it's going to decline. And that's when having these physical metals is where all the value is at. It's going to become a world of embedded energy. And embedded energy means that you used cheap energy to get these things out of the ground. You purchased it under that cheap energy environment. And then the environment market condition changes where those things become ultra valuable because it becomes much harder to get out of the ground, both from an energy perspective, the energy cost, and from a declining ore reserve. HFI Research says this week's EIA crude storage report showed a draw of 1.8 million barrels, which is in line with our estimate. U.S. oil production is currently around 13.3-ish million barrels per day. So we continue to draw down inventory. This is supposed to be build season, guys. If we don't build now, what's going to occur when we come up to next summer? This is going to be one heck of a move. It's going to be interesting. Eric Nuttall says U.S. oil inventories are at their largest deficit to normal levels since December of 2022. This despite weak demand and surging U.S. shale production. We're at the lowest level with 2022. We're supposed to be in build season. See, we are supposed to be building upward in this. See the red line where it builds upward from these weeks here? We're not really building much. This is going to get really, really low. And I think they're in there jacking with oil price. They have to be, because if they weren't, we would get builds and we would be in building season. But if we're not getting builds, then why is the oil price this low? We should be killing some demand and increasing a little bit of supply to get the builds back to normal levels. Cross-border capital, it says, here's a chart gift. Happy Thanksgiving, everyone. BTC doesn't have a PE, price to earnings ratio, but it and many other things move very closely with liquidity. Here we track our GLI metric, not M2, advanced by 3 months versus the 6 week change in Bitcoin back to 2015. Maybe another buying opportunity ahead. And you can see how this moves back and forth. Bitcoin price is up. You can see GLI has a sharp decline coming. So we could see a potential pullback in Bitcoin at some point here. That's also what MSTR is probably pricing in, is this pullback here, MicroStrategy. Just an FYI. Rock bottom entry says the US dollar is in the process of putting in a major top. Most will sell their precious metals at the worst possible moment. We'll be buying. Correct. And here we are with a potential shoulder, head, shoulder. Maybe that comes up. We've got a bearish divergence in the relative strength indicator, and maybe we get a rollover in the dollar. That's also going to be a tailwind behind not just precious metals, but also a lot of commodities. Here's Grady. This ratio chart shows how historically undervalued gold is in relative to the US currency supply. So gold has a very long way to go compared to the M2. And silver will outperform gold, and silver miners will outperform silver, plus everything else. Lifetime opportunity, no rerun here. And what we've got is a reverse symmetry move where we came on down, we do a double bottom, and then we're going to come all the way back up. Now, this is going to take time. It's not going to be a short-term market movement. He says, look at the two very similar positive divergences and what happened after the first one back in 2005. Once we went into the positive territory of MACD, that's when things go crazy. So we come up, 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 and we go positive. That's when things go ballistic. And we are in the positive territory just now, and it looks like we could potentially have a very big move for gold outperforming the M2 money supply. That is a market condition that it's describing. That also correlates with a declining dollar, if you want to know. The Fed is about to face a policy quagmire, in my view, with core PCE inflation now at 2.8%. Today's data reaffirms that consumer prices are likely bottoming. History suggests we might be witnessing the start of a second inflationary wave. What makes this situation unique is the Fed's limited capacity to combat this second wave, as rising rates further could exacerbate the government's already heavy debt burden. I can't stress this enough. This scenario is profoundly bearish for the US dollar, in my view. Adding to this, Trump has repeatedly advocated for a weaker dollar, further compounding this bearish USD view. And this is the three inflationary waves of the 1970s. And he's saying that we are here in 1971-72, and I agree with that. Home sales declined here. This is a housing market boom and bust, boom and bust, boom and bust. The housing market and the credit expansion drove this. If we get lower rates, it's just going to push up another housing market boom and credit expansion and all that stuff that comes with it. So yeah, I would agree with him. Looks pretty good. And that's what I've got for today, guys. So give me a thumb up for the content. Subscribe to the channel. Subscribe to the website. Black Friday coupon code, one word, if you'd like to join. We've got a Sunday question and answer session coming up at 5 p.m. Mountain Time. That's all I've got for today, guys. So we'll catch you next time. This is Finding Value.